I would think about, like, if you and I were at a campsite and we're being chased by a bear, I don't have to be faster than the bear. I just need to be faster than you. And that's kind of the way you need to think about that. From an investment perspective, lots of opportunities out there for companies that are really getting into the AI space. And so from that end, it's very exciting. So how you do this as a worker, you be careful, you keep yourself and your skills up. As an investor, you look at that as an opportunity to really take advantage of.
When you started the story with when you and I were at a campsite, I started to get really scared, and then it had a much better ending than I expected, so it was fine. It actually made your point really well. So Doug Flynn will be contributing to this show on a regular basis, we hope, unless we get AI to replace him. But thank you very much for coming on today, Doug. It's good to see you. What's a sensible amount of money these days to keep at home? A lot of us don't have a lot of cash anywhere we go, whether it's at home or even going out anymore, you know?
That's true. I think, there's two parts of cash, right? There's the cash, that the old adage of having 3 to 6 months expenses in the bank or in savings for an emergency. But what we're really talking about here is what you should keep on hand on your premises in your house. And I think, as anyone who lived through Hurricane Sandy did, like we did, where you were out of power for 13 days, I think 2 weeks is a pretty reasonable amount of time to have cash on hand.
Is that what's going to happen? Will we hold 8% mortgages for a while? Where do you see rates?
It's very possible. Normally you want to look, if you're shopping for a mortgage, you want to look at the 10-year Treasury yield.
Right.
There's typically about a 2% spread between the Treasury yield and mortgage rates. Right now, it's at 3%. And so it is likely that if you see the 10-year Treasury hit 5%, it almost got there and then it backed off a little bit, that you could, with that current 3% spread, hit 8% on mortgages. And the Fed has said they're going to raise rates again. So it is likely that you touch that before it begins to ease. And that's a gallon of gas that tends to fall off in the fall after the summer driving season. So we probably could absorb a little bit of an increase in price before you really feel it. But yes, if there's more disruptions or if it gets completely out of whack, it'll eventually translate into where we all feel it as consumers. The market has kind of raised interest rates without them having to do it. So that's why he's saying, there's a little bit of a pause, but they've left the door open that, hey, maybe we don't raise in November, but we still might in December. And the market's really hoping that we're done. I don't know that we're done. Maybe they will, maybe they won't. They'll use the next month to see the data. And if they don't raise, they're going to leave the window open or the door open for maybe one more raise in January just to keep us all waiting. But at some point, they'll stop. And that's the trigger point we're all waiting for. When they stop raising and they say that, well, we can glean it, then things begin to move the way we want them to move.
Yeah, it was much easier years ago when Alan Greenspan was the Fed chairman and nobody knew what he was talking about. And he used to do it on purpose. But now with this guy, you kind of do know, but you're still not sure what he means.
And the thing you have to be very careful about is that most people end up staying in their house a little bit longer than they intended. So even if you think you're going to stay in there for 3 or 4 years, you might end up on the other side of that staying 6 to 8. And here's what happens. If you're saving 1% per year for those 5 years versus the current fixed, which is great, you're sort of banking that 5%, but then you might get hit with those renewals on the other side every year.
Right.
Now, the max they typically go up is 2% a year, but you have to think, if the worst thing happens and everybody's wrong and rates are up and housing is down and you can't get out, your break even there is about 7.5 years. So if you end up staying there for 10 years, you could end up with a loser. I mean, he left the door open, but basically Wall Street and investors are completely ignoring that he's going to raise rates. And now they're not expecting him to raise again, if he does at all, into the first quarter of 2024. So they're basically blowing off that he's ever going to raise again and just assuming that he's not. And if they're wrong, then the market's going to correct itself. But if they're right, then it's taking advantage of that opportunity right now. There are things that are getting cheaper, such as eggs are down 22%, lumber's down 20%. There are other things that are actually deflating. So that's like negative inflation. But overall, we still have inflation, but it's actually technically considered disinflation because it just means that the rate of inflation is lowering. We still have inflation.
Still going up, just not as much.
Exactly. And deflation, if you actually do get negative prices, that sounds great because things will cost less. And sometimes people think, oh, well, if we have lower inflation, we'll end up with lower prices. Not necessarily, but
by the way, when you get your truck, we'll send a crew. We'll have you drive into the studio here.
Awesome.
You would look great coming out. We'll document the whole thing. The tough-looking Doug Flynn coming out of a Cybertruck. Thank you, Doug.
Got a deal.
All right.
December. What's the state of the stock market for everyone's 401k as you see it right now?
Yeah, a couple of good things. If you look at months where we had more than 8% in a month, like we did in November, if you look at the last 30 times that happened, 27 of the times, 1 year later, the market was positive, and the average positive was about 16%. So that bodes pretty well when you have a great month like that. It's very normal after 5 straight weeks of positives to have a little bit of flattening. Now, I can use some indices like my Christmas card index at my house. I think I have 6 Christmas cards. In the past, we've gotten 20. So I don't know what's going on. People are cutting back somewhere, I guess.
That could also be a personal thing, Doug. I don't want to say it. But
could be.
You never know. You don't want to read into it. Not everything's an economic indicator. I'm not saying. I hope you got ours this year, by the way.
Sort of in medical applications, for example, having AI get down to maybe the local area level and determine what specific drugs, what duration, and what dosage would they need in this place versus that place to attack a particular virus or particular outbreak. And I found that quite fascinating because we don't tend to do that. Like the flu shot is like, this is the flu shot you get. Yes. And there's no individualness to it.
Doug's been helping us out with our coverage of business news as we've launched the show. But what he does for a living is he's a financial planner. So he's helping people, real people, your clients, get set for the end of the year. So we have your financial planning strategies for the end of the year, what a lot of people talk about. So there's 3 things here. We'll try to go through them. One is tax loss harvesting, okay. The other is withdrawing RMDs, which we'll explain in a moment, and then Roth IRA conversions. So let's talk about it. Stocks or bonds? What do you think heading into 2024?
Yes. I mean, we like stocks, but we love bonds. And part of the reason why is because the stock market is at or near its all-time high. And so you have to tread very carefully when you're buying things at the high. If you look at the bond market, it just came off of the worst 2 years in its history. It was down about 20%. Now, it has come back about 9% in these 2 months, and that's true.
Thank you, Doug. As always, Doug Flynn on that.
Merry Christmas to you guys.
Merry Christmas to you as well. We appreciate you giving us so much time.